Well, hello, everybody. Welcome to Wall Street Hackers, one of the most exciting programs on the Pod TV network, which we discuss the stock market. In addition to the stock market, we're going to look at the quotes of the week and stories of the week, Peter's pick for the week, and of course, a panel discussion. And we'll do this all in about 30 minutes for the certified financial planners who have joined us and the registered financial consultants in the United States and people around the world. So with that, we're going to bring in the hacker himself, who's a graduate of UCLA, where he received his degree in economics. He also received a law degree from the University of Miami and his master's in business administration from New York University. After that, he went to work on the streets of Manhattan and New York for about 17 years and bring this wealth of knowledge about what happens in the market and what we should be able to do for ourselves and our clients, none other than Peter Bennett. Peter Bennett, welcome to your show.
Oh, hey, Nick. Thank you for the introduction and welcome, audience. As regular watchers know, you can catch a new episode every Thursday, starting every Thursday at 1, most weeks or Saturdays, depending on your distribution channel. So we always start with the markets. There's an interesting story I have about that too. But first, we start with the general information. The markets hit, quote, record highs again this week, as reported over and over again. But as we keep reporting, the S&P actually is almost exactly even now against inflation since December 21. So for 2.5 years, basically, at least the average person is not making any money at all, except for they're keeping up with inflation, which isn't terrible, but that's not the goal. And it's hard to get ahead if you're only matching inflation. So what's noticeable, particularly and encouraging for the stock market in terms of appreciation, is bond yields have been falling. And just about maybe 5 weeks ago or so, I strongly recommended, or a recommendation of the week was long-term treasuries. And at that time, you get about 4.7 or 4.8 on a 30-year treasury. And I locked some in. I locked a lot in, and especially my Roth IRA and IRA. I said, you know what? I would have been begging for that 2.5 years ago when rates were about 2%. And if I can lock that in, it's a nice flow from my IRAs. I didn't put everything into it, but I bought a chunk and I recommended it. Anyway, by just yesterday, you could get a total of 4.4%, which doesn't look quite as appealing. I would point out that even in a non-qualified account, treasuries are exempt from state tax. So that's helpful, makes that yield worth a little more. But as bond yields go down, and I'm not saying they are, because there's still an inflation fight and it's certainly not over. I mean, I am not sure at all about the direction of bond yields. I'm thinking they're going to drop a little more, but they may very well go up because the inflation fight isn't over, because the factors that created it aren't over. There's still low unemployment, massive government spending, even on the books, not to mention off the books, and very quite possibly high energy prices. That we're heading into the summer driving season. Plus, there were some events that weren't well reported. In Ukraine attacked a Russian facility, which could affect the energy prices, and also the Houthis. And the story said it likely took over another ship in the Red Sea. All this isn't good for the energy market, but in the short run, we're not about the short run. We're about long-term investing in businesses. And so the other thing that we are sure about, besides that we're almost sure inflation is going to continue for quite a while, is that eventually rates are heading to zero. And that will help the market a bit, because the governments of the world, most, if not all, are in so much debt, including the United States. I've looked at countries in Europe and Asia and South America. They all have underfunded pensions, and they're all offering healthcare benefits that they never really funded, and huge deficits there. If you look at it on a GAAP basis, it's staggering. And so these countries, people are concerned about the Medicare crisis, but all these countries that are offering free health care to aging demographics or aging populations are going to be under the same stress. So they'll be using yield curve control to bring down rates. They'll certainly 100% be trying it and almost certainly succeed. It's been done in multiple countries in multiple years, and that will bring rates down. So my prediction is maybe 5, 6, 7 years, we're going to start being approaching zero, maybe negative rates, and that could stay for decades. And that'll be create a stagflationary environment, very likely, and also probably, and certainly very likely inflation higher than what you can get in almost anywhere. So it's good to lock in your returns now if you can, long term in terms of stocks and bonds and REITs. So different story, and this should have been a major story, and I only saw it reported in one place. It could be because it's not that favorable to the Biden administration, and so a lot of the media bury stories and never even mention them if they don't like them. It's like, oh, we don't like the story, so let's not mention it. But here it is. Saudi Arabia has decided not to renew its 50-year petrodollar agreement with the U.S. The petrodollar agreement was formed in 1974, and it increased trade ties between the Saudis and the U.S. It was obviously very good for the U.S. and the Saudis. But the decision to move away from the agreement enables Saudi Arabia now to sell oil and trade in multiple currencies. And historically, oil was traded in dollars. As a matter of fact, 80% of global oil sales today are in US dollars. Now, you'd say, okay, they'll trade another dollar, in other currencies, but it's not that simple because the US uses the dollar as a very important tool to maintain its position as a global superpower. And so if it shifts, the U.S. is going to lose some real leverage in the world in terms of finance and economics and geopolitics too. It isn't good. How did this happen? Well, unfortunately, I have to point to the president again for a good point, for 2 points. One, he had a very non-aggressive policy, let's say, towards Iran. He's been too friendly towards Iran, too soft on Iran. And the Saudis do not like that because they are basically at war with Iran, at least through their proxies. And two, and this you could argue rightly and wrongly, because I try to look at every side and don't just say I hate Biden, just like so many in the media say I hate Trump nonstop. But morally, I see his point, but he's been pushing very hard on the murder of Jamal Khashoggi, and who was a journalist and an American who the Saudis very likely just killed for political purposes. I'm not positive about that, but let me put it this way. There's allegations that they did that. So he's been pushing them very hard on that subject, and they don't like it. So it's not good for the relations. And the change in the Petro agreement is a major story, and it has been basically hidden by the mainstream media, or they haven't noticed it, which is unbelievable. Very likely because we're in an election year. And this story will relate to our panel question of the week, which we'll have after our other discussions. And the question of the week will be, is America currently, or will America in the future, lose its place as a global superpower? So we'll be discussing that in the latter part of the show. So quotes of the week. They're all selected quotes from one article in Barron's, the Weekend Barron's, last weekend. But they all point to the same thing, basically. So 4 quotes in a row. I won't keep saying quote. Magnificent Seven. There's only the Magnificent One. In 2023, all 7 were in fact magnificent. Each had a starring role in the market, but so far this year, NVIDIA is the Magnificent One. NVIDIA's contribution of 32%, let's say, of the S&P 500's total return through May 31st exceeds the 21% total contribution of the other 6. He then says, I know that I don't know where NVIDIA will go from here, though I sure wish I did. So first point is NVIDIA has been running the market, but that's one stock. And I don't know where it's going to go to. And I don't bet on when I don't know. I try to always know. Usually I'm right, but I go with the odds. But here's what I did find out today. I looked up on E-Trade what the targets are for NVIDIA. And today, it's Wednesday that we're filming this week for technical reasons. The target of analysts on NVIDIA is $5 below its current price. Now, normally you want the target to be at least 10 or 20. I want it to be at least 10 or 20% higher, the growth. And you can't really find this out, but what target time? They don't put a time on it a lot. It's at 6 months a year, but roughly you're talking about that. That's where they're aiming for. So they're aiming for no growth on average or $5 less. So is NVIDIA going to carry the market? Who knows? It's got a lot of momentum. I'm not as much of a trend trader, but it becomes more and more speculative. And even if it goes up another 10% or 20%, then it won't be able to carry the market. At some point, it's going to hit a top and people are going to start selling it. And it could be any day. I'm seeing articles on both sides. So interesting stories of the week. We have three most interesting. Usually we do more, but they're kind of long. Number one, the Biden campaign is running campaign ads saying President Trump is, quote, a convicted criminal. And they're right. Trump is a convicted criminal. But the reason is because the Biden administration arranged one of the most rigged trials in history and convicted him of an 8-year-old non-disclosure agreement that at best should have been a misdemeanor. And that's not to mention that President Trump has a right to appeal, and it may or may not be reversed, but there's at least a decent chance of reversal, but no predictions there. So forgetting about that fact, the Biden administration has no qualms about following the footsteps, the exact footsteps of Russia, who put Putin put his main rival Navalny in jail, and then he died in jail, and South American dictatorships. No problem there, but here's the real problem besides that. He is setting a precedent that could change American history in terms of presidential elections. There are Republican prosecutors and Democrat prosecutors. So what happens if, and everybody makes some mistake they could try, especially on trumped up charges, no pun intended. So basically, what happens in the future? Every presidential election, they're going to say, oh, now we're prosecuting him. We're prosecuting him. Both presidential candidates are going to be tried for ridiculous things. It's unconstitutional. It's un-American, and it's outrageous, bottom line. So we will see where that goes, but it's not good. Interesting story number two. So I watched MSNBC and CNN. I do look at their shows to see the counter arguments and stuff. Although those two particularly, I have a lot of problems with a lot of times, but it depends what the point they're making. Sometimes they make valid points. So I watched for 2 hours straight, and because I started watching, I said, wait a minute, I'm hearing nothing at all, not one single paragraph that wasn't about hating Trump. I said, how long will it take till I find something? So I watched 2 hours, and there wasn't a single paragraph where I could stop watching and say, okay, that paragraph wasn't about we hate Trump. That's basically every single sentence, so every paragraph. And the point is, one, that there wasn't a single paragraph that couldn't have been exactly written by the DNC. Two, I said, okay, if I could at least find something unfavorable about Biden, just one sentence or paragraph, at least I can stop watching this 2 hours. Nothing unfavorable about Biden. Every single paragraph, we hate Trump. I don't know why people watch this, but the problem I have with it not only is that, and many Democrats should have problems with this too. And there's couple of reasons why, if I was a Democrat, I'd be concerned if I look deeper. One, the level of intellectual discussion on these shows is pretty much nil, and a lot of times, depending on who's the narrations, and a lot of times it's really just name calling or putting out stories. But here's the thing: they're destroying not only the country in terms of dividing it 50-50 by putting out false narratives, but also they're actually doing a lot of harm to the long-term and I believe the short-term Democratic Party. Why? Number one, because if you don't have some kind of litmus test for the quality of candidates and for your elected officials, if you just, we love you because you're a Democrat, no matter what you do, then, and we don't question your policies, what you do? You start getting crazy policies like the Democrats are doing. This is probably why they've gone this way. You would never have thought 5 years ago or 10 years ago the Democrats would be pushing basically pro-crime policies all over the place. Open borders. A lot of people would question their attacking Israel so much, and on and on. And having little problem with inflation because the economy is, quote, good. So this isn't good for anybody. It's not good for the Democrats, not for the Republicans. Oh, I take it back. It is good for one people. It's good for the ratings. So it's all about the money for them. So no ethics, but you know what? They can drive ratings by saying, if you hate Trump, watch our show. And that brings in people and it creates a cycle. I hate Trump because I watch the show. So I always watch the show because I want to hear what I can do to hate Trump more. So, but it doesn't, this is very damaging to the country. And it's very damaging to the Democratic Party too. Interesting story number 3. Tenants and owners in every neighborhood in New York City are now suffering the effects of years of economically damaging housing policies, basically rent control. The New York City Rent Guidelines Board just generated data that reveals a 10% increase in the number of financial distressed, rent-stabilized buildings just in the last year. There are thousands of buildings across New York City that are, quote, distressed buildings and that need significant physical renovations and repairs. The economically ruinous rent laws cap a building's only income, basically its rent rolls, but it doesn't provide corresponding reductions in operating expenses or costly mandates, which keep going up. So they say, we'll freeze the rents, but we won't necessarily even keep up with your costs or taxes and everything else. So right now in New York City, this is unbelievable. 75% of New York City apartments in buildings with 6 to 20 units are in desperate need of upgrades. And yet apartment improvements have declined 77% since 2019. That is not a good trend for New York City. Tax delinquencies of rent-stabilized buildings rose 26% over the past 2 years. So eventually landlords say, you know what? I'm going to take the money. I'm going to walk away from my property, take everything I can out of it. I'm losing money anyway. I can just bilk it basically and walk away. And they don't have a choice. In the end, they lose the property, but they walk away with the cash that they can walk away with and then declare bankruptcy, I suppose, or they're probably in LLCs anyway, so they don't have to worry about it if they're smart, obviously, and they just close down the entity and lose their property, but at least they make some money in the meantime, and that from their perspective. So rents in New York City are through the roof. They're outrageous, as most people know, in many places around the country now, but also, especially in cities, but also there's a housing shortage. You would think if rents are high, this should help a housing shortage, but it's socialism at its best. It hasn't worked in dozens of countries throughout so many years now, since the 1800s. They keep trying the experiments, and so many individual experiments, from the Pilgrims to individual communes. It pretty much never works in the long run, and it does lead to dictatorship and totalitarianism where it has historically flowed in terms of direction. So what to do? The one section that really hasn't changed, and fortunately we didn't need to change it. So in terms of your investments, we say own energy because it's the sector that outperforms in almost any time frame and outperforms every sector over almost every time frame. Obviously, tech's done well under certain time frames, but most time frames, energy is your solid investment. It outperforms, and especially pipelines, although we also like some energy producers and utilities. And we'll continue with those in coming weeks. Own dividend stocks. This is the no-brainer, at least in terms of history. In the 50 years to 2022, the S&P 500 doubled the performance. Dividend stocks doubled the performance of the S&P 500. Dividend growth stocks tripled the S&P 500 performance over 50 years. And dividend stock, non-growth stocks and dividend stocks that didn't pay a dividend hardly got any return compared to the other stocks. And finally, it's always true, but you need to be extra selective now in terms of your picks, in terms of stocks and REITs. We're in a very tough macro environment and macroeconomic environment, you want to have, and this is what we look for, businesses with good cash flows. We like good dividends and good cash flows, and balance sheets that are going to thrive in any environment, especially a inflationary and probably stagflationary environment. There's a pretty good chance of that. So dividend pick of the week. 1 second. I don't get a break anymore in my advertising in the middle of the show. So disclosures, Wall Street Hackers is for entertainment only. These are only our opinions. There's no guarantees, and nobody can ever make really a guarantee on an investment except for maybe a CD, but that's even not guaranteed against inflation. And consult your financial advisor. So almost every week for whatever it was, 2 years maybe now, we've come up with new picks. But this week, we're really not discussing a lot because we're discussing some changes in the portfolio. And they're pretty big core changes. So we recommended EPD, although I've had it even longer, but we recommended EPD, a 5% allocation just 5 months ago. And we're just closing out EPD. We had about a 10% profit in EPD over 5 months, which wasn't bad, and also collected dividends. So we got about 11% profit in the last 5 months. And it's not like we don't like EPD. I like EPD, but I don't, and I like it more than thousands of other stocks. If I had to pick another stock, I'd definitely be looking at EPD as a possibility. It's a pipeline. It has a 7-point-something% yield. Although now there's up, it's a little less. But the thing is, I have some concerns for a few reasons. Number one, I have concerns because there are forecasts that the natural gas liquids utilization rates are basically peaking. What that means is basically they built so many pipelines now, the capacity is up in the Permian and other places, and that may put some pressure on the prices. And there's actually a forecast by some that in 2025, natural gas pipeline rates will be going down. I think EPD will still do fine in that situation, but that's not a great trend for EPD. But the other thing is we have such a large allocation to energy. I barely want to say it, but with EPD, I was over 40% in energy now, and because it did pretty well. MPLX did fabulously, and that was our biggest allocation by far. KRP has done well too. So I basically had to redeploy the money. I bought some treasuries. I did some other things, but I also upped KRP from 4% to 4.25%. I don't want to own too much KRP because it is subject to prices on oil and gas and commodity prices, and you don't want to be. It might be too much risk, especially since there's other things I own that are subject to that too. But I do love KRP. It has an 11% yield. 16% of all active rigs are on their huge amount of land. They own a huge tracts of land, and 16% of all active rigs, oil rigs, are running on their land right now. It has a price to cash flow of 9, so it's easily covering the yield plus a little more, and it's very low debt to assets at 0.22. So this is a solid company. I think oils and gas prices are going to hold. Maybe natural gas will fall particularly, but it's hard to say. So as a hedge against the rest of the portfolio, because if inflation really kicks up, it will be energy that drives it. I want to own some oil producers. So I own about 5% in energy producers, because if it goes up a lot, maybe it'll even hurt the pipelines in the long run because people won't be able to want to pipe so much. But also, it'll certainly hurt other stocks like my shopping center REITs. And next week, I have a perfect example of a stock that could be hurt. It's my first recommendation on a consumer staple that I've liked for, I don't know, maybe 6 months or longer now, a year. And but a lot of stocks will be hurt if energy prices go up. So it's a good hedge against everything. And the other side is if an 11% yield dropped to 6, and that's not bad either. As long as, and the last point I'll make there is a lot of the return is even if it's held in a non-qualified account, not a non-IRA, it's still tax a lot of its return of capital. So we really have to hurry again. So I say, panel question of the week: is America currently losing, or will America lose in the future, its place as a global superpower? And we only have 3 minutes to close out. So background is discussed. Saudi Arabia now dropped the petrochemical agreement. The U.S. is outrageously in debt in terms of not 35 trillion, but 125 trillion when you count unfunded liabilities for Medicare and Social Security. There are multiple geopolitical threats right now that the U.S. hasn't been dealing with. I would point out that there was supposed to be a peace dividend when the Berlin Wall fell, and I'll skip my point there. But the peace dividend was squandered totally, so the question, Nick, is, and we have to go quickly, so take a short time. We have 2 minutes. Is America currently losing its position as a superpower, or will it be losing its superpower status in the future? Go ahead. Take about a minute.
Okay. Well, the metrics say yes, it is losing its status. Okay. But let's look at the metrics. One metric is the gross domestic product relative to the world. Right after World War II, we had 50% of the GDP was in the United States of America. Today, it's 24%. So we lost ground over the last, since World War II, from 50% to 24%. That's not going up, that's going down. Number two, our education system. Our education system was number one in the world. Today, our K through 12 education system doesn't even crack the top 25.
Oh, yeah.
So people around the world are being more educated. Number three, our debt ratios, and our debt are just our nominal debt, 35 trillion. The next country that has debt that's huge, that falls into number two, remember we're 35 trillion, is actually the United Kingdom. It's 9 trillion. 9 trillion. And China, who definitely wants to become the world superpower, has amazing debt of 4 trillion. So when you look at that, we have a national debt hanging over our head. We're losing in education. We're losing in our GDP. So America continues to spend more money than they take in. The last budget, we were almost 2 trillion extra in the hole. And every 100 days, we had 100 trillion. We had
so we're not going to finish this discussion because you made, I would refute one.
Those are the metrics.
But the other side is that you made some good points, and this is too complex to take on. So I'm going to try to leave a really extra amount of time next week to get into this, because I had 2 main points. But you made some points that I need to address, and some of them are good, starting with the education system. So we're out of time. So thanks for watching Wall Street Hackers. We will see you next week. As Kim says, get healthy, get wealthy. See you soon.